Welcome to Blaxe Academy Make the Play PTA. PTA stands for Post Trade Analysis, and it's the process by which trades are analyzed from start to finish so traders can understand what went right and, more importantly, what went wrong. The entire point of PTA is to help the trader become better. So, before we begin, here's an important trading term that you must know to make any sense of this recording, and that's risk event. A risk event is any event in a financial market with an uncertain outcome that really matters to all the people in the markets. An example would be periodic reports about the status of the economy. Ironically enough, that's exactly what we're going to talk about. We're going to talk about the PTA of today's CPI report, but also a speech from a central bank person like Chairman Powell from the US Federal Reserve. Those tend to matter. They end up being risk events that are highly anticipated. And also details about long awaited trade deals like Brexit or USMCA from a few years ago often induce a lot of volatility in the markets. Now, remember, for investors, volatility isn't necessarily a good thing, but traders, when they're in their bag, thrive on being able to use volatility, play in volatility, and make the best of the opportunities and the uncertainty. For risk events, there's generally two ways to trade it. First way is to get ahead of the news event. That means, in a sense, to anticipate or make a bet on what's going to happen before you actually know it. Sounds scary? Not so much. Other is to trade after the event occurs, see what happens, and then generally gauge what the market's going to do and make good decisions on that. But the key element of trading this and why we bring this to your attention in the first place is so that you can make good decisions. Now, let's talk a little bit more about this CPI report. Today's event had the market all flustered and in a good way. The consumer price inflation report for the month of October rose 7.7%, and the market loved it. I know I said CPI rose and the market loved it, but that's because it rose less than expected. The market analysts were expecting 7.9% rise in inflationary prices across the basket of goods, but 7.7 came in lower, and it also came lower than the actual reading for the prior month, which was September. If you strip away energy prices and food prices, the core CPI, as they call it, was even colder than expected, rising only 0.3% versus 0.6% in September. It's ironic, the last two CPI reports, the market went nuts in the opposite direction. Today was a great trade day for traders and great day for talking heads on TV and investors alike because the market went up. But the point here is this: the CPI report, whether you knew this or not, offers great playmaker opportunities. These are the people that get down in the markets, those who know the information, know how to process and use the information. Hey, this is how traders can get paid. Now, looking a little deeper, this is the 11th CPI report for this year. Every month, the Bureau of Labor Statistics, BLS, releases the CPI report showing how inflation measures across the United States. Well, the good news here, if you look at the data here, you can see that there's correlation between how S&P 500 performs, and I'm looking at the end of the day, but it typically you can measure this across from just the onset of the news event. The CPI report happens just about the same time in the middle of the month every month. So again, this is an opportunity that you will see over and over again. What you want to notice here is the difference between what's forecasted, and the forecast is what the market expects, and what's actually released in the data. Once the data is released and the report happens at 7:30 a.m. Central Standard Time, the market does its thing. When the actual data comes in worse than expected or higher than expected here, like look at February of 2022, the S&P fell that time. Same thing in June, and also the worst one of this year thus far was in September, looking at the August data. The reason being, the market, for whatever reason, thought that the CPI had peaked in the prior month and they were expecting lower numbers, and they got much higher readings. Strangely enough, 0.3, 0.2% in the CPI reading is actually a big deal. As you can see, the market reflected negatively in September, a minus 4.32% in a single day. Well, it's quite the opposite of that now in November, 2 months later. We came in under the reading, 0.2%, and the market is up 4.37%. A great day. Now, I talk a lot about what makes good traders, what makes informed traders. Part of that is knowing what to do. The other part of that is knowing where to do it. We're talking about CPI, sure. We're talking about the United States, and most people are going to default to saying, well, sure, you make some type of trade in the stock market. Yeah, you can, but the way you really might want to get down is to consider the entirety of the financial markets. When you're going to trade event risks, understand that different markets are going to react to the data based on their underlying characteristics. Stocks, or equities as they're called, they're sensitive to changes in the interest rates in the region, as we've seen this year. The Fed's been on a hiking tear because inflation has been at a 40-year high. The rate and pace at which the Fed has hiked has also been commensurate to that 40-year pace. So stocks have suffered. You still could trade them. You still could trade on the CPI report. A lot of the down stocks were up today. Some in great measures, much higher than even the S&P 500. But you could also trade bonds because bonds are also interest rate sensitive assets. So there's some stuff to play there. But I'm going to skip to it and be honest. The markets that are continuous, which means that they don't stop during the day, namely currency markets, the foreign exchange, commodity markets, futures, and cryptocurrencies, offer continuous market opportunities that allow you to play ahead of the news. And I know you might be shaking your head as to saying, well, why would I guess on the news? You're not going to guess on the news. I'm going to tell you how in just a second. But more importantly, this is about the where. If you learn the tendencies of certain markets, like for example, currencies are all about interest rates. And if interest rates are influenced by inflation, then the CPI is going to matter a lot to currencies. Which currencies? We're talking about CPI in the United States. So the currencies that are paired up with the US dollar, I've named a few here. Also some currencies that are really sensitive to risk as well. This gets a little bit more advanced, but it still works out the same. The more you try it, the more you practice, the more you'll get used to this. But in particular, I like to combine, especially where we're going, a little bit of this equity action because a lot of people love to trade stocks. But if you want to get the best of the both worlds, one should maybe consider the futures market, particularly the stock futures market, like the E-mini, which is the S&P 500 in futures form, or the NQ, the NASDAQ in futures form. But again, commodity markets, you could trade crude oil, bonds in the futures format, but also metals, precious metals like gold, industrial metals like silver, copper. They tend to be sensitive to this interest rate talk as well. So once again, there are tons of ways to trade it. Now I want to show you one, maybe two if we have time, and I'm going to let you guess as to where I'm going to start out first. Here we are at the Spider, the S&P ETF. This is sort of a home court for a lot of stock traders. They find that the Spider is easy to trade. You get a broad access to the market. And for swing trading, day trading, even options, there's a lot going on here. Now, I'm going to show you where, in general terms, the CPI report was. You see, there is a gap here in the data. The reason there is a gap is because the CPI data happened before the stock market opened. So even though you're trading an ETF that's an exchange traded fund, that exchange doesn't open until 8:30 Central. So even though the CPI report happened an hour earlier, the best you can do is follow along and maybe get some of the action here. It's respectable, but as you can see, the gap in price here is much larger than the opportunity available after the news event is up. So again, you can trade this after the news event, but for those traders that can take on a little bit more risk or that may be more knowledgeable, more experienced, there's another way, and I've already hinted at it. We can just take this same S&P, which we know and love, and transpose it into the world of futures, which is continuous. Here we have the exact same look, except for, if you notice, there's a big, long candlestick here. That's because there's no gaps here. The reason why there's no gaps, the futures market, even in S&P terms, was open at 7:30. Let me go down for a closer look. Exactly at 7:30, you can see that there was a monstrous move. Now, keep in mind, traders, that we did not know that the price was going to go up, at least not yet. We never really know the future. But you can see of that 4.37% move today, 3.11% happened in the first candle. And for reference, every point in futures, at least trading on the S&P ES E-mini future, is $50 a point. I'm not going to do the math for you, but that was 117 points in just this first candle. Again, it's a pretty significant move. That works for you, of course, in this situation. It also can work against you. So again, be very careful. Use stop losses. Use good risk management. Only trade what you can afford to lose, and only that. But more to the point of what we're talking about, I particularly like the method of getting ahead of the news. And I know that may sound a little crazy because I don't know what's in the news report. What's going to sound even crazier is that I don't really care. Now that I have your attention, I'm going to show you exactly why I don't care. As a technical trader, part of what we teach at Blaxe Academy as foundational material is to learn how to read out what the market may do next to the best of your probabilities by seeing patterns in the charts. We're very pattern centric. We're very price centric. Most people believe that everything's based or priced into the price. Sure. Most of the information is. We have more than enough of what we need to make good decisions along with our risk management most of the time in the markets. I'm going to show you how this works in the simplest terms without you having to actually take our courses. But I'm hoping that once I show you, it'll make sense as to why you need to take our courses. So I can take us back to the beginning of the year. No, I'm actually going to take us back just to mid-August. The market itself makes a couple patterns that repeat, repeat, repeat. And there's some variation to it as you might expect, but of the patterns, I find one in particular that is foundational to just about all the rest. And this is what we call the measured move. If you've been around on the net or you've been trading around for a while, you've probably heard this term before. It's really just a series of three moves: one up, one back, one down, or you can go in the opposite direction. In this sequence of events, this pattern, if you will, gives rise to all sorts of other things, even other patterns that you may know, may recognize. What makes this pattern more than just colorful lines on the screen is the fact that each part of the pattern relates to the next part of the pattern. And that's so critical. How does it relate? Glad you asked. Well, it relates by what we find Fibonacci levels. Now, you may have heard lots of things about Fibonacci. Most of them are probably bad, but I'm here to tell you, you probably heard them bad because the people who told you didn't know what they're doing. Well, that's not us. We know and love Fibonacci, and we know and love Fibonacci to use them to make sure that our patterns are what we think they are. And why this is important? Because if the patterns can link together in the market, like I'm showing here, hypothetically, they can actually relate in the market in other places as well, not so hypothetical. For example, if I was just to take the length of this move in the market and take a multiple, Fibonacci, if you will, I can find also this move in the market relates to it as well. So all I have to do is measure from one end to the next, and we can see just by the intersection of these horizontal lines, this little move up in the market was about half. Sure, looks like a parlor trick, but there's more. The next move in the market comes down here is also going to relate to this small move and this move as well, because by our estimation, by our practice, we find that moves that are next to each other or adjacent in the markets tend to be related by Fibonacci terms. So if I take this same length and reapply, now using another Fibonacci tool, using a few more levels, I can find relationships like these. Take these off for simplicity's sake. And we can see that just like the smaller move was about half of the initial move, we can see that this next move was 144.7, which is a strange number, but believe me, it happens and it shows up enough. In fact, its occurrence is a pattern in itself. So I can continue to do and show these relationships between different parts of the market over and over again here, such that there's a repetition that forms up. Like you see at the bottom of the screen, notice there was 144.7 here, and there's also one down here. But I can continue to build upon this sequence, and the sequence itself becomes a pattern. I know that sounds very, I guess you could say woke or whatever, but next world, but it's true. This move here relates to the thing next to it by a Fibonacci ratio. Of course, skeptics out there, you guys are right. Knowing which one is of utmost importance, but there's a sequence to knowing which one as well. And just as I've drawn these patterns, all these colorful lines, what I find in the market is that there's an insistence on this same pattern going over and over again. There's actually one smaller one inside of here as well. Let me draw it first so that you can see. Take these away, or at least move them to the other side. And show that practically all of these have some sort of relationship with each other. If I move from here to here, I'll find that the move to this spot there. It's a good guess, sure, you can call it that. But if I'm able to do it over and over with some level of consistency, like here to here, watch as I measure, you'll start to see that all of this starts to come together in some form, fashion. 0.6 here, and one of these. Let's put the 100. There we go. Now, Some of you may just say I'm just drawing lines, but watch this. If we combine what we have with these patterns with Fibonacci levels, I'm going to take you slightly ahead of when the news happened, which is, again, this is what we espouse to being able to do, is see what the market can see and repeat this pattern. I have these levels that have been drawn several different times, but I will show you that they overlap and interact with much larger levels as well. I'm going to change the color of these, sort of bring them out a little bit more. As you can see, this 50% level overlaps with our 100% level that we drew from here. What this shows you is that this is a point of, as we would call it, resistance. Just like down here, there's points of what would be support. Now, if I was to take from this low, give a starting point to the highest point since, I'm going to show the more terminal color, I can repeat the same Fibonacci measurements, take a retracement from here of the entire structure. And what you'll start to find is that we can now set what I consider to be bounds around the current price. Here and here, I'm going to change these colors as well and flip the orientation just a bit. So, heading into the news, this is early. I'm going to come down in time frame as well so we can see a little bit more granularity. And once I do come down in time frame, we see this same measured move pattern happening over and over again. And this is a good thing because remember, we want our patterns to happen over and over again. Just like I have the pattern here, this is almost exactly opposite to the one I drew out in space. I could draw another one from here to here, goes down like so. And even though, bear with me, the lines are crowding, you can see that the current price here is bound between these two seemingly coincident lines of 38.2 and 41.4. This is a good thing because as I have a move up, a move back down, my next expectation is that this same pattern moves up and it's going to come down by a certain degree and it should move back up. Why? Because this has been the same repeating pattern over and over again. No other reason. I don't have any other logical explanation. It's barely an explanation as that, but experientially, I see it work in and out of the markets so much that it's hard to ignore. And it's honestly, it's hard not to share it. Now, as I clean up some of these lines, I'm going to show something. This area is where I expect the markets to take their run. Why? I don't know anything other than the fact that the CPI report is going to come out at 7:30 and the market is going to react. What I expect is react is going to induce volatility either higher or lower. To protect myself from the lower bound, what I do is I invoke risk management. Again, you can't trade in the markets by my estimation without using some type of stop loss, some type of protection. Some markets like options, where you're buying puts and calls, there's a built-in stop loss, so you can sort of limit like that. With futures, currencies, stocks, you have to use a little bit better risk management. Here, only on these events, you shouldn't go in. This is not a gamble like this where you have to put all your chips on the table. Instead, take only a small portion of your bag, small portion of your risk capital, and apply it however you see fit, but make sure it is small. Now, I'm going to say from this 38.2, I want to initiate a long position because I think the market is going to come down, bounce this level, and go higher. I'm going to put my stop below this 41.4% level because if it goes below there, There's some other levels too. I could widen it out, but it sort of dilutes the nature of my trade. I want this trade to be pretty potent. I want my target to be maybe here, which, as you can see, for those that know price action, there's some levels through here. But specifically for our pattern, if I took the length of this one and then added it to here, there's another way to sort of estimate where we should go. And there we have it. It really overlaps what we already have, which is a beautiful part of this. So now, by my estimations, if we can get up here, if we can move the market right, we're right with the market. CPI comes in wherever it comes in. Every $1 that I risk, I get 8 3/4 in return. That's a good risk reward ratio. That's worth my time. If I'm wrong and it goes the other way, I get stopped out, take the small loss. But if I'm right, based on these patterns, based on all these markings that you see, it looks like this could be a good trading day. And this is why we trade risk events. The other part of this, there's not a lot of waiting. As this, I'll start to show you as we go along. In the futures market, boom, you can see there's 730 and it screamed higher. It blew through all of our levels. It went so much higher so quickly. It was over. Most of it was over here. But if we hit our targets, we had a great day. We could have stretched the target. If you made it to the end of the day, you have a trade that is $12 to every $1 of risk. That's incredible. That's 12x, 1200%. This is the impetus for doing it like this. This is the impetus for getting ahead of the news event. I didn't know, and I didn't care to know what was contained in the CPI report. What I was betting on, what I was trying to make my good decision, my good bet on, was the patterns that presented themselves. And these are patterns, again, that you see even when there are no news events. This is why pattern-based analysis by estimation is so very important. This is also why continuous markets allow you a little bit of advantage that you can play some of these news events if you're smart, if you're prepared, and you're ready to manage your risk. This is an incredible opportunity that you can get every time there's a CPI report, perhaps. There's one every month. And if you really get into the macro world of finance, you'll find that there are CPI reports for other economies as well that you have access to. Now, if you didn't want to trade stocks or futures, believe it or not, this same trade setup is present elsewhere. This is a currency, euro, that is versus the US dollar. Like we talked about before, the US dollar is sensitive to changes or threats of change to the interest rate. And here again, we see the same patterns, these same measured moves, the same sorts of retracements come out to be about my estimation from 41.4. Sure. And all of these moves in the market relate to each other. From here to here, you can read them in advance. None of this was actually a surprise. But that's if you're studied, that's if you're well-versed in our style of pattern-based, price-based analysis of the markets. This is our 730 candle. 200 pips, looks give or take, maybe a little bit less, but the whole drive was definitely about 200 pips. That's good money in currency trading. You can trade a number of markets using these techniques, and you don't have to know the future. You don't have to forecast. You have to make good decisions about risk, and you have to do good analysis using your patterns, using your Fibonacci's. This is why we drew it to your attention. There's opportunity here, and it's going to be continued as there's changes to the world economies, but especially the United States. Now, it wouldn't be a good PTA if you didn't have something to take away, if you didn't have something to learn. What you learn here is that technical analysis is key to trading everything, including risk events like the CPI reports. Well, how do you do it? Use known patterns to get yourself ahead and position smartly ahead of the news. What makes it smart is that your risk management has to look good. It has to make sense. You don't have to know what's going to happen in the report. Don't care. Read what the market's trying to tell you. It will surprise you in what it knows. Also, broaden your horizon. You may trade one market, or you may have never considered to trade risk events. Well, open yourself to multiple opportunities, and you'll find that you have many different ways to play other than just day trading or swing trading or position trading or whatever you do. There's something else out here. There's dozens of markets and dozens of reports. So that gives hundreds of opportunities, maybe even more. And who cares if you miss the initial move? If you're not ready to get ahead of this, there are ways to play the after. It may not be as big of a move, but if you can be consistent, if you can make good decisions, that's far more important. And lastly, also firstly, real technical skills matter. I started Blaxe Academy to make sure that traders had an opportunity to learn real skills, to interact with the market, use their analytical skills, and make good decisions on a consistent basis. This has helped me navigate the markets for almost 2 decades, and I know it can help you. So come join us at Blaxe Academy. We have PTA takeaways every month. We also have courses on futures, options, all the markets that you ever want to know. Also, this foundational price based analysis that you can't be without. We hope that you enjoyed this, that you come see us at Blaxe Academy. Always know enough to move forward. Thank you much.